it always bothers me when people tell me you can't time the market, or when people say that you can't short-term trade, you can't, and you talk to academics, and it's always an uphill battle. There'll be people that will tell you that, and it's common wisdom, if you will, that technicals don't work and things like that. But in the meantime, I personally know, you personally know, and have personal experience making very good money using these tools of supply and demand.
Welcome to the Market Call Show, where we discuss what's happening in the markets and the impact on your investments. Tune in every Thursday on Apple Podcast, Google Play, Spotify, or wherever you listen to podcasts.
Brian Shannon is I'm so glad, I should say, to see you.
Well, likewise, I am glad, Louis.
I met you for the very first time at a Chartered Market Technicians meeting in New York. You're basically neighbors. You live in the same city as I do. Had no idea who you were. My bad, because I've come to find out that you're a very, very talented trader and, more importantly, educator.
Well, thank you.
And I was really happy to have you say yes to come talk to me. And I really want to share some of the things that I've learned from you, and I want you to share with my audience some of the kind of learning that you've had over the years in trading the markets. And you have such I would call it a varied background in the investment world. I think you can bring a lot to the table for people to understand. Anybody who's a trader themselves or an investor, because your background really brings a lot into the fray. I mean, I guess I should back up a little bit just to tell the audience a little bit about you. You're the founder of Alpha Trends.
Yep.
And it's an online swing trading analysis and education community founded in 2010. And you handed me your first book, Technical Analysis of Using Multiple Timeframes. But you have a new book out, which I'm really excited about. It's doing very well. It's called Maximum Trading Gains with Anchored VWAP.
Yeah.
And I will kind of talk a little bit about that. You say that that VWAP is the perfect combination of price, time, and volume. And I agree with you. And I wanted to hear a little bit more about that. And your book is doing well, #1 bestseller on Amazon in the investment analysis and strategy category as of yesterday when I looked at it.
Yep.
So that's great. And when I was looking at your background, not only do you mentor and train people, you trade on your own as a successful trader, but early in your career, you had this like a stock brokerage firm type background with Lehman Brothers and Dane Bosworth, and even you were a manager. Can you tell me a little bit about your evolution from a broker to a trader?
Yeah, sure. I mean, and thanks for having me on, Louis. It's always good to chat with you. I respect what you do, and obviously you have a lot of knowledge in the technical area. So I appreciate being on with somebody who can speak the language. So I started out as a retail stockbroker in Boston in 1991 after graduating college. That was my way into the investment world. I was kind of naive, truthfully. I thought that I would be, buying and selling stocks, not a telemarketer, basically, is what it turned out to be. So, at Lehman, I learned how to sell, which is always a great life skill. I think they should teach that in high schools, how to sell, because we're all always selling things. But I moved to Denver in 1993 and worked with Dane Bosworth at downtown. And actually, it's funny because I joined a CMT meeting downtown back way in 93 or 94. I don't know if you were running it back then.
I was.
You were. And I lobbied my manager, Dane Bosworth, to cover the cost of being a CMT, and they wouldn't do it. So I gave up on the CMT. I just kind of, just started doing this brokerage thing, stuck with that for about a year. And then I opened a day trading office. I actually went to work for myself for a little while and traded for myself, and then opened a day trading office downtown Denver. And that was, right across the street from Union Station. It was great real estate right there on the first floor. I can't imagine what the cost of it is today. So I opened this day trading office because I had my Series 7 and 63. Then I got a 24, so I could be the branch manager, office manager. And stuck with that for about a year, and then started to work with a company called MarketWise.
Mhm.
They were based in Broomfield. He kind of acquired our customers and went to work for them, and that was really a good career move because it gave some more structure to what I was doing. Plus, the guy I did it with was a con man. He actually went to prison for running a
Wow.
Ponzi scheme after he stole from me, and I fired. We broke that up, but that's a story for another day.
Yeah.
Uh,
I bet
so
we could talk for a long time about that one, but anyhow.
yeah. So anyways, I started this office and then went to MarketWise
Hmm.
and worked with them for about 10 years and created educational material for them, ran their prop desk. So the guy who was running the prop desk, he brought in about 30 traders, and two or three of them were profitable. And so my boss got, the owner, David, got rid of the manager, and he said, Brian, I want you to run this prop desk and start teaching them how to make money. So I looked at 30 traders there, and I said, well, Dave, I can't deal with 30 of these guys. He goes, okay, well, fire half of them. I'm like, what? I've never fired anyone in my life. So
Wow.
anyways, we cut it down, and we turned it around. Actually, a lot of them became profitable, and a couple of them I'm still in touch with this day. But after MarketWise kind of wound down, I did my own thing, which was to start Alpha Trends. And I started it as just on YouTube. It wasn't even actually YouTube yet. YouTube, I was uploading to Google Videos, and
Hmm.
then Google Videos, acquired YouTube. And so I've been on YouTube, since the inception of YouTube, basically,
Mm.
doing technical analysis videos. And about 3 years after, doing these videos, I was approached by Howard Linson over at StockTwits, and he asked me, "Hey, do you want to, join up and offer your service as a subscription product? I think a lot of people could benefit." I was, well, sure, let's do that. So I've been running a subscription product for the last 15 or so years. And I, cater to swing trading, as you had mentioned in the intro. So that could be anywhere from one day if we get stopped out, it wasn't a swing trade, up to generally 2 to 3 weeks is my preferred time frame. So in 2008, I wrote the book Technical Analysis Using Multiple Time Frames. And this year, I just finished the Maximum Trading Gains without Anchored VWAP, as you mentioned. So that's just a start. I'll let you choose where to go from there.
Well, okay. So first of all, let's back up a little bit and talk about how you got into technical work, because you're working for firms that were primarily fundamental in their like sales pitches and why you did what you did. How in the heck did you go from that fundamental storytelling to more of a technical strategy? A lot,
Oh,
most
it's
people
pretty
don't make that jump very quickly.
it's pretty interesting the way that evolved, and that's a good question. But so in high school, I used to go to I was interested in the stock markets. I used to go to the local library and read the Cabot Market Letter,
Oh
which
yeah,
is still around these days.
yeah.
And there was a stock in there that they were talking about that said, we want to buy this stock if it gets above $5 a share. And I read it. I was thinking, that's insane. Why would you want to pay higher? Then you turn the page, and they had a chart, and you could just see this resistance at 5. So I had money saved up. I was a freshman in college actually at this time. I bought 1,000 shares of it, and it went up 2 points in the next 3 weeks, and I got
Nice.
out of it. And I said, boom, done.
Now
So it
now you're
made
hooked.
sense. I looked for and found a technical analysis book, and that was Stan Weinstein's Secret for Profiting Bull and Bear Markets, which has a huge influence still to this day on everything I do each and every day in the market. So
Yeah.
that's where I really caught the bug. And he wrote that in a way that really just made sense. From there, I went to Murphy's book, and then I just devoured every technical analysis book I could.
So
And
hold on just a second now.
yeah, yeah.
I have to honestly, I'm embarrassed to tell you that I've never read any of Stan's work.
Oh, well, there's only one. So,
Okay, so I've seen the book and I've read your book, and
uh
I can see the influence from your book,
right.
but it seems so simple. Give me the most powerful lesson that you've learned from his work, if you can, in a nutshell?
The cyclical flow of money through the markets, the four stages, just like the stages of the economy. The markets are a discounting mechanism. They anticipate what's going to happen 6 to 9 months down the road. But back to what you just said, simplicity, and that I just posted that on Twitter last night. Simplicity is the market's greatest disguise. Everyone's always trying to look for this complicated formula when it's just supply and demand. We want to know what motivates people in certain areas, either fundamentally or technically. So at Lehman Brothers, I got lucky in that I worked for their top producer. I guess the manager saw something. I was kind of a smart ass when I went in for the interview, and he said, "Hey, you'll do well with this guy. He's our top producer in the office." And his name was Michael Collins. And he had a strategy that he used where he married the fundamentals with the chart. And he was looking at positive earnings surprises. So this was back in 1990, 91, 92. So he would get the Investors Business Daily, daily graphs books, the blue and green ones. And, he would say, "Brian, go cut out these charts and blow them up 3 times on the photocopier." So I would, start paying attention. And he would look for companies that reported increase in revenues and better than expected earnings, and they had a good, chart. And I saw him making a lot more money for his clients in that office than other ones who were pitching the garbage that Lehman Brothers was pitching. It wasn't all garbage, I shouldn't say that, but they a lot of it was just like, "Hey, move this stock, whatever," type things.
Sure.
Not necessarily. He was making real money for his clients. So I was really lucky to see that.
This is really important what you're saying, though, Brian, because you came out of the sell side, and you learn like how the sausage is made on the sell side, right? Yeah. And you see the public has this impression about what is Merrill Lynch all about. It's and what is Lehman Brothers. They're supposed to know everything. Smith Barney. And then when you get in, because I have a similar background, right? I worked for Kemper Securities, which used to be Betcher. When you get in, you realize that the name of the game for them is not necessarily making great returns for their clients. The name of the game is moving AUM, assets under management, getting commission revenue. At that time, it was more commission revenue.
There was more commission then, yeah.
And so that was a secondary consideration. But at some point, you must have realized that, hey, I'm in this game to make money, not necessarily for clients and for myself. Not necessarily just to be a salesperson. You mentioned, so you must have been motivated in a different way than a lot of the guys in the office that were just like, "Hey, I just want to gross commission a certain amount," or something like that.
I took really very little pleasure from sales. I got pretty good at it, just because it's just talking and convincing people of things. But I wasn't really always sure that it was the best thing for that person, but it was an opportunity to there's definitely a conflict of interest a lot of times, in that you're trying to hit a certain number of commissions per month, and you're trying to do better and open new accounts, and you've got to part of the sales process isn't just telling a good story, but embellishing a little bit to capture that fear, capture the FOMO from someone on the other of the line saying, you're right, I need to own that stock, Brian. Let's buy, 4,000 shares of it at $22 a share. That's great. And I'm just thinking, well, that means this many dollars in commission. So, I really enjoyed looking at the stocks, figuring them out and just trying to figure the puzzle out.
How did you move to the shorter time frame? Because that's not the time frame they were probably promoting to you at that time.
No, and I had a few talks about that. I got called into the branch manager's office about, velocity of the money. And, they tried to get me to sell bonds and real estate products. And I told them I have no interest in doing that. I'm not going to do it. They said, "Well, you rescheduled you for the test." I said, "Fine, I'm not studying." And I didn't study and I failed. And they said, "Well, we rescheduled you. Make sure you study this time." I said, "I'm not going to study." And I failed it again. I said, "I'm a stock guy." And back then it was like, "Oh, he's just a stock jockey." I took pride in that. Yeah, I like stocks. That's my thing. I don't want to be an annuity salesman or mutual funds. I don't believe in those. I think we can do better than them. So, I was a little bit, so 1991, I guess I was, 26 years old or something like that. Whatever the math is, but, 27, I guess. Anyways, the point is that it wasn't my passion. I didn't enjoy it. That's the way I was in school as well, Lewis. If I didn't enjoy it, I just did enough to get by. I was a C student, but when I saw a class I liked, I would just get an A, and I didn't really have to learn too much. It would just come naturally. So it's kind of interesting the way, I guess I had a stubborn mindset and just always knew what I wanted to do and thought, well, that's what I'm going to do. People are putting these roadblocks up.
Yeah. So you felt natural just being in the shorter time frame from the get-go, it sounds like just in general.
Yeah. And the main reason for that, I think, is that I, to this day, am incredibly risk averse. People might think, well, you're a trader, you take all these risks. Like, I take way less risk than anyone with a portfolio does.
Yes.
Last year I made money. I wasn't down less than the S&P 500. I made money. And this year I'm trailing a little bit because we got off to this, monster start, and I wasn't going to chase it. Now my gains are creeping up as the market has come lower, and I know I'll surpass it. And it comes. So to me, it's about risk management first. It truly is, because I had some early, about 2 weeks before I started as a full-time trader, I was saving up money, $25,000 to get a leveraged account with generic trading in New York City. And I was trading this stock called Chantal Pharmaceutical. CHTL was the symbol. And I had gotten my account from, $7,000. I was thinking, well, I'm going to be able to be a pro trader, maybe in a year. But I ran my account from $7,000 to like $23,000, $24,000 in about 2 months. And it was mainly through this stock. And I was trading it really well. I'd sell it on the rallies, buy it, as it started, rallying back up again. And one weekend I held 2,000 shares over the weekend. And over the weekend, Barron's did a hit piece on it, and it opened 7 points lower the next day. So I was down $14,000. So I did what any responsible person, and here I am calling myself risk averse. I went and borrowed money off of my credit cards and said, I'm doing this anyway. So I took out money on a credit card with a baby at home, a wife who was, working part-time, and a house we had just bought, and said, I'm going for it. So, that loss taught me immediately, I cannot lose big amounts. This is my one shot, is the way I saw it. I quit my job at Dane Bosworth. They thought I was insane. And everyone, my dad thought I was insane. Everyone thought it was crazy. But I made it work. I was just grinding away, making a couple grand a month at first. And I was young. So, I made enough to get by, but I couldn't screw up because, I had no other job. I had really no skills besides, I didn't want to go be a stock slinger, broker again.
But I love this. I love this story because it always bothers me when people tell me you can't time the market, or when people say that you can't short-term trade, right. You can't, and you talk to academics. And it's always an uphill battle. There'll be people that will tell you that, and it's common wisdom, if you will, that technicals don't work and things like that. But in the meantime, I personally know, you personally know, and have personal experience making very good money using these tools of supply and demand. And I was just recently talking to Tom Basso, who you're probably familiar with. And he's got a whole chapter in his new book. I was reading his new book that's just now getting ready to come out about timing the market. And he has this wonderful story about why everybody's got that wrong. And not only that, so there's two things. One is timing the market. That's counterintuitive. The second thing about your work that really I enjoy listening to you talk about is the fact that you're in a shorter term time frame, which is, people always say you have to be long term. Well, I think I've told you this before. I've done studies where actually it shows that the reward risk ratio is actually superior in the shorter term time frames. but there's transaction costs and other things that you got to deal with, but you must be extremely nimble and you must know what you're doing in risk management. So
Right.
one of the things that I love about what you do is, and I don't know everything that you do and I want to learn more, but is you have this context first. You start with a context of what is the overall cycle, right? And then from there, how are we going to execute in a time frame that makes sense, and what tools can I use that are not the mainstream tools, which I think is really important to what you're doing. You're not just buying breakouts too. A lot of times you'll be looking at pullbacks, it appears, and that you're looking for reversals. And again, I have not seen a lot of your work, but I've been playing around with the VWAP since you told me about it, which was I think it's over 5 years ago now.
Yeah.
And I have found it to be very, and first of all, there wasn't a lot of firms out there that actually had it out there.
Right.
So I had to actually go through and create the date. What's the date? I programmed it in and said, what's the date? Put the date in and then watched it from there. Now you can just click on a button and we'll get into all this. Okay.
Yeah.
So quietly behind the scenes, you and I don't talk very often. I've been watching VWAP for a while.
Right.
And I find it to be extremely powerful. I actually saw a recent interview with you on IBD. That was a really good interview, and you demonstrated that quite a bit, so people can understand kind of what it means. And that kind of leads me to this whole anchored VWAP. Can you just explain in your words what volatile or volume weighted average price is, why it's important?
Yeah. So I know a lot of people that you talk to do dollar cost averaging, where they'll take $1,000 a month and put it into a mutual fund or whatever. And at the end of the year, they want to find out what their dollar cost average is. Well, the dollar cost average is basically their volume weighted average price. So what the volume weighted average price is, it was invented in 1988 to create a benchmark to say, here's how well an order was executed. The original authors of it defined the volume weighted average price as the price that a naive trader could expect to receive. Because that's, when you adjust all the trades by every single share traded, here's the true mathematical cumulative average price. So it's cumulative from the beginning of the day. And that's the way it typically had been measured. Then I think it was 1993, Dr. Paul Levine, started playing around with it, and he would anchor to different points. He had different names for it and all that sort of thing, but he was truly the pioneer. He died in, I think, 96 or 98. And with it, a lot of his, work kind of just got stuck and, it really didn't go anywhere, which is really surprising. So I first started noticing it in 2003 with the software I was using. And I noticed that if you began from an earnings report that was maybe 8 days ago, there was a lot of value to that. And so the volume weighted average price, just the traditional VWAP, is the measurement for one day. It's cumulative throughout the day. And the anchored VWAP, just you choose the start point. You say, I'm going to anchor it to the earnings report. I'm going to anchor it to the beginning of the year. Anchor it to the Federal Reserve, or the most recent high, or the most recent low, or the highest high, and get value from that. Because what it tells us really is, where are we in relation to that volume weighted average price with current prices? If we're above it, it means the buyers are in control. 100% certainty, we know the buyers are in control. 100% certainty, we know the short sellers on average from the beginning of that measurement are losing money. So it's great to tell us, with complete objectivity, who's in control. The subjective part, though, is where you start the anchor from.
Yeah. So when you say in control, and I like that term a lot.
Yeah.
Buyers in control, sellers in control, and you're hearing more and more people use that verbiage. What you mean, correct me if I'm wrong, is basically that they're at a profit if they're in control.
Yes. Yeah. So again, it's the price that a naive trader, a long trader, could have expected to get during that period of measurement. The price that a naive, and it's not all of them, of course, but if you take on average, what's the crowd psychology? And that's what we're trying to really determine is, the market doesn't care about my opinion and me anchoring it to, where I bought the stock. It's more about the collective memory of the market, where there's shared emotions in the market. And that's what we're really trying to get to, because, emotion, motivates people, for fear of missing out, as we know. And there's just a lot of price action based around those memories. We look at traditional horizontal support and resistance, and it still has a lot of meaning. But when we throw an anchored VWAP, we get a deeper understanding of why that is there. It's more about, the sellers are selling it down to a level where they perceive there will be value, and then they stop selling, so there's less supply. The shorts sell it down to a level where they think buyers might step in, so they stop selling short, they start covering, there's less supply and there's more demand. Sideline money comes in and says, hey, that's a place where I think there should be buying. I'm going to start to nibble here. More demand from the sidelines. So it's all about trying to look at it and say, what's the true supply and demand here, rather than, and there's nothing wrong with heads and shoulders and cups and handles and ascending triangles. But what's more important is to understand the psychology of how those patterns are being formed and what it means. You have to look at a chart and say, how would I feel if I was long? How would I feel if I was short? What about the people who are in the sidelines? What are they waiting for to get interested in this chart, in this stock, so that they might take action? That becomes the level of interest. And the level of interest just says, here's where I expect this battle to be fought out between the buyers and sellers. Because the primary trend is higher, I'm expecting it's most likely, because a trend once established is more likely to continue than reverse, a basic principle of technical analysis. I'm expecting it's more likely to continue. So I'm going to look for evidence that the buyers are gaining control in there. I don't want to buy the pullback. I don't want to buy the touch of a VWAP or a moving average, but I want to look at that shorter term time frame and see evidence that the buyers are gaining control. And that evidence might be, well, it pulled back from 35 down to 31, and I anchor a VWAP to that 35 peak. And as long as it's below that, the short term, the sellers are in control. But as soon as it starts battling with that level and the bigger level, now we're saying, okay, it has the potential to resume that more powerful uptrend. So I want to get involved at that onset of the momentum in the short term, because the bigger powerful trend is still presumed to be in place. And if I'm wrong, then I set my stop below the most recent relevant low for the time frame I'm involved.
Yeah, and that is, there's two things that I've noticed about this concept. One is that it allows you to see the character of a particular move more deeply, what's inside of it. And it's
Right.
not as easy. You don't have to visually look at the days up and the days down and as much. You get more information very quickly summarized. The other thing is, when you do see the stalling pattern or whatever, the stepping in that you're expecting, you can anticipate it. First of all, you say, maybe this might happen.
Right.
So you're kind of ready.
Yes.
And then once it does start happening, then you can watch it very closely at that point. And then you have a very low risk entry point. That's the key. Because if you're wrong, you can quickly exit out of that if you're a shorter term trader. If you're a longer term trader or investor, you could use that as a point to add on. You could use, you might have already initiated a position, and it will allow you to have some reasonable points that make sense, if you're not a shorter term trader. So it's just another tool. And it's not like overbought and oversold and all these other indicators, which are linear in nature. They have a look back and they go
Right.
back like in a certain amount. That assumes that markets have rhythm. And yes, they do have rhythm, but rhythm shifts. I
Right.
did a whole thing on Real Vision on that to actually show that quantitatively, how rhythms in the market shift, and that there's no single time frame that you could use that is going to be reliable ever.
Mm-hmm.
So what you have to look at, and I want to defer back to your thoughts on this, is where you put that. How are you going to decide that you're going to actually place your anchor? You have a lot of work done on that. From the work that I've done, it's mostly related to how much volume there was, what peaks and troughs, and what kind of bases you're in. Earnings reports are absolutely important.
Yep.
But you have a lot more experience in that. So I want to talk a little bit about that part of your thinking. What is your overall approach when saying, okay, I'm going to anchor here, or I'm going to anchor there? What do you, how do you look at that?
Generally, like anything, Lewis, that kind of created a supply demand shock, right? So I refer to that as, maybe a gap. Gaps are great. Was the gap caused by a reaction to an earnings report? So those are often some of the best. A brand new IPO, everyone has the same measure from the beginning. So our collective memory of price is tied to that first print, unless you got shares on the IPO itself. But in the aftermarket, we all have it opened at $18.65. So if we measure from that point forward, we know, are the buyers or sellers in control from the beginning of this, the birth of this stock. As you mentioned, peaks and troughs. So just a week, 3 weeks ago, the Nasdaq 100 got up to the anchored volume weighted average price from the all-time high, and it stopped dead in its tracks. Today, that same Nasdaq 100, or Friday rather, came down to the year-to-date anchored volume weighted average price, and today we're getting a 2% bounce, 1.5% bounce from that level. I don't know that it is going to be the low, but I knew in advance that was an important level, because portfolio managers look at the beginning of the year and they say, hey, the market was up 12%, now it's pulling back. Let's try to get involved at the average price that this market has traded at. So they defend that level and they say, here's where we need to buy some, because rather than be the FOMO buyer who chases when it's 2 standard deviations above that, I want to buy close to this level and start to nibble and see if in fact it turns to support. And so far it's looking like it, but it's always, we only know in hindsight any of this stuff, right? So we look at it and say, whether it is an overbought or oversold level, or it's a moving average, or it's an anchored VWAP, we look at them and say, this is a clue that tells me to look. And I view fundamentals as just the same, actually, that just because the revenues were up and the earnings were up and people are talking about it, that tells me, okay, it's worth looking into. Now I want to measure that on price action. Some people look at the PE ratio and they use that as their starting point, but they don't buy, or they shouldn't buy, just because of the PE ratio. I mean, some people do, but it's the starting point. And rather than just a mathematical formulation, like you said, like with overbought and oversold, we're looking at true supply and demand. It's not subjective. What are people saying they're doing with their money? But it's actual price truth. This is the average price. If the buyers are going to maintain control, they're going to defend it in this area. I'm going to observe that in the shorter term time frame, buy at the onset of new momentum, and get involved in the before the, again, using the stock that ran from, dropped from 36 to 32. There's going to be a group, 3 weeks down the road, I'll buy it at 33 and a half, let's say, as it makes that shorter term higher high. Well, then, 4 days later, it breaks out to 36.25.
Yeah.
I'm going to sell some to that.
A lot of traders make the mistake of doing things the way, they'll read books and they'll look at these obvious chart patterns and obvious breakouts with a cup and handle or whatever that book that they read. And more seasoned traders that make money are usually already involved with that and either trimming there if they're shorter term, or they might be topping off their position at that time, knowing that they have a higher probability of a pullback on that breakout the following day, or maybe even that same day. And it depends on the market environment. Like in today's market environment, you have the follow through has not been as much as we've seen in other environments. And, 60, maybe 60, 70% of the time, that's kind of how it is. So when you have those great follow through markets, that 30% of the time when we're just like in the ripping bull, that's when it's easy for everybody.
Yeah.
But it's in that 60%, 70% of the time when you're trying to make money, if you're a stock trader, you must have a different approach if you're going to make money. I mean, if you're buy and hold and you're 60-40 stock bond, you're going to get a certain outcome. Maybe it's an okay outcome over the long run, maybe not. One where I see a lot of value in this VWAP is in more of the mean reversion related strategies, but it could be used for breakouts. It could be used for mean reversion. It could be used for whatever technique.
Absolutely.
But in that shorter term time frame, for me personally, I found it most valuable on the mean reversion trades.
Mm-hmm.
When everybody is going, something happened, it sold off, there was a great earnings report and it stalled out on heavy volume, and then the thing falls down after that, right? Because the market's not so hot, not so strong. But then it hits that VWAP and it has great fundamentals, and then the institutions start picking it up. And
that definitely is happening.
That's where you pick it up right there. You don't wait till the obvious breakout. Right. We got to teach some traders to stop there, because a lot of new traders are coming in. That's what they're doing. They're reading the classic books. Correct me if I'm wrong. That's what I'm seeing.
No, I think you're absolutely right, Lewis, is that people are applying old concepts. The market has gotten a lot more sophisticated. When I started full-time trading, it was basically 1993, and breakouts were working. It was simple. You just had to buy as it breaks a new high. It didn't matter if it was up 10% the week before. It just kept going. Nowadays, they're more sophisticated. You have to, there was a quote about somebody saying, you have to anticipate the anticipators.
Mm-hmm.
Everything I do and talk about is, so going back to Stan Weinstein in the 4 stages, when it's in a stage 2 uptrend, we want to participate on the long side. Stage 3 distribution, we want to, exit our position. And maybe if you're looking to get short, you start to anticipate the decline. And then in the stage 4 decline, if you're a long only trader, you just avoid it. If you're a short seller, that's where you participate when it goes from stage 3 to stage 4. And you get that analysis on multiple timeframes. It's not just breaking down to a new low below the 200-day moving average on your week, your 2-year chart. It's about, using the timeframes together. So on the same thing, my favorite types of trades, I prefer the long side trade, is a stock in an uptrend. And as I mentioned, it's in an uptrend on the weekly time frame. So I know that the big trend has more chance of success, especially if it's a fresh stage 2 on the weekly. Maybe it's been in existence for 2 to 3 months. That's really kind of the sweet spot. And there's just, and earnings reports are starting to come out positive and that sort of thing. And as the stock pulls back, gets ahead of itself, it pulls back. And that pullback, when you look at it on a shorter term time frame, well, the high was basically, might have taken a day and a half to make that high. On a shorter term time frame, that shows as a stage 3 distribution. The 3-day pullback shows as a stage 4 decline below a shorter term moving average, lower highs and lower lows. Stage 1 accumulation, it takes a day and a half to 3 days to go sideways, to absorb the supply, have the new buyers step in and create that stronghold there. And then as it just breaks to that higher high in the shorter term time frame, that stage 2, well, we've been anticipating that breakout and planning our trade in stage 1. Stage 2, as soon as the price tells us to, we participate. Another thing that a lot of people I've seen a mistake is people say, well, there's it's up, but it's not up on much volume. But if you understand how volume actually works, volume expands with the direction of the trend, peaks at the turning point, and pulls back as it diminishes. So if you're first one there at the onset of stage 2 on the shorter term time frame, at first it's going to feel lonely until you start to get used to it. You're like, where is everybody? Yep. Well, the human nature is people start getting excited 2 to 3 days later because they're talking about it on television. Why is this stock up 10% in the last 3 days? Oh, it's breaking out. Here you go. Take some of mine. I bought it down there. And now the volume is coming into it because the big institutions are saying, sell some when I can, not when I have to. I want to sell it to the uninformed, uneducated, less sophisticated breakout traders. I'm going to sell part of my position, and then it pulls back over the next week and a half. Let's say I sell 300,000 shares up there. I'm going to buy another 150 on the pullback and support it and help create that stage 1 accumulation and give other people the confidence that there's still buyers in here.
Yeah, that to your point on the volume, Jason Meshnick,
Yeah, of course.
I did a research thing for him because he created this volume indicator that you might be familiar with, where he's looking at the volume of the market as a whole. So I did a whole volume quantitative analysis, and that exactly what you said is true, that the actual forward-looking returns don't happen on high volume, they happen on low volume. So you really want to have a quiet market that is expanding in volatility in your direction. And that happens generally when the average true ranges, the volatility is expanding, and the volume is expanding in your direction. But when you pick it up is when it's quiet.
Yeah.
And when, or you would like to, and that's where you could see you have to kind of go to a shorter time frame. And this is one of the things I think is really nice about your work, is that you've got this concept of context, multiple time frames. Where are we in the cycle? And then drilling, it's like a funnel almost. And, where you're saying, okay, where are we in context? And let's get closer and closer when we get to what you call an area of interest. And I want you to expand upon that a little bit more. Then you get really more, I guess, drilling down, I assume. Am I right about
granular.
that?
It's again, so it's based on, the fundamentals of technical analysis, that Charles Dow wrote. Again, a trend once established is more likely to continue in reverse. There are the oceanic tides, there are the minor ripples, and I forgot the way he described them, but he described it to the ocean, and saying basically that there's different time frames. So when you have those time frames aligned, which was multiple time technical analysis using multiple time frames in my first book, it's that's the guiding principle to me, is to say I don't want to buy the dip. Because what if it keeps dipping and dipping and dipping and reverses? And we saw that happen in 2022, that all these stocks that people thought were, hey, what a great opportunity for me to buy this stock 20% off. What a value here. Well, it's below the declining 20, 50, 100, 150, 200-day moving average. Money is flowing out. Don't buy this. It's not a dip. It's in a downtrend. So I want to avoid those stocks or look for a short opportunity. But again, my preference is long. That's where I make most of my money. So it comes down to, again, just saying that anchored VWAP from the beginning of the year, from the earnings report, whatever it is, it's pulled back to that. That's my level of interest. It's not my place to do business necessarily, and it might end up being a place to do business. But I have to look at that and say, now drill down to a shorter term time frame, so I can dial in with my microscope and see really what's happening under the surface. If I wait on a daily chart for this to develop, and say I'm using a candlestick and say, "Ooh, that's a doji," I knew it was a doji forming at 10:30 a.m.
in the
by
middle
looking
of the day,
inside and watching how that doji formed. And what was the VWAP for that day? Did the buyers maintain control, or was it above and below it? If it's backing forth above and below the VWAP for that day, it tells me it's not quite ready yet. There's still a battle down here. The next day, it gaps up, pulls back, and tests that first day VWAP and holds, and then gets back above that day's VWAP. It's telling me, okay, there's perceived value in here. And then 2 to 3 days later, as it flattens out, makes that little higher high. That's where I want to get involved. I don't want to buy the dip, and I don't want to buy involved in that neutral period. Let the institutions do the dirty work. It's my job to jump on as soon as the market has told me unequivocally, because it's above the anchored VWAP from that high at $36 a share 5 days ago, and it's holding the VWAP from the low at $29.72 on the pullback it made 3 days ago. Now it's above that, and it's making that higher high. That tells me with 100% certainty the average short seller is losing money. The average long is making money. That confirms the bigger trend on the daily time frame, that it's pulled back. Now it's ready to go again. It's undergone that that supply and demand struggle, that it's found its equilibrium, and now the buyers can much easier grab control of it again, because the trend is more likely to continue than reverse.
So one thing that I was thinking about while you're talking is that individual investors have so much of an advantage because they can move very quickly, whereas institutions can't.
Right.
And this is a valuable tool for individuals who want to create wealth faster by moving faster and compounding their edge more frequently. It's also a useful tool for institutional investors who have a longer term system that they're working in, framework, and they need to execute the best they possibly can. Right. I know I need to buy $25 million of this stock. And I'm going to use this type of technique to help me get into that stock. So this is not something that is just for short-term swing traders, in my opinion.
No, not at all.
It could be used for long-term investors, right?
I mean, that's why I was talking about the NASDAQ high in 2021, and it was still relevant here on February 25th and the 27th here today. So these are, levels that say who's in control from a certain area. And when it runs up quickly to that level, it's more likely it's going to sell off. But if it rallies up, creates a higher low in 2 weeks, and rallies up and bumps up against it again, and then comes down a week later and then blasts through it, it's just the story of supply and demand. The buyers are getting more aggressive because they've made, they made this low, let's say February 27th, and I'm just making this up. Maybe March 15th, there's a higher low. And then on March 22nd, there's a higher low, and it came up to that VWAP from the peak. The first time it hit it, and then 2 weeks later it hits it again. Then a week later it hits it again. Well, the higher lows tell us the buyers are getting more aggressive price-wise. They're not waiting for a pullback in the Qs to 300, 290. Instead, they're taking control at maybe 295. And then the next test, they take control at 298. Well, they're getting more aggressive. They're getting more impatient. They're saying, I don't think it's going to pull back that deep. Let's go in there and buy as much as we can because we think it's going to break higher, and we need to be positioned for that. And the sellers who are there at the anchored VWAP from the all-time high, they start running out of supply. So the buyers are getting more aggressive price-wise and time-wise because it was it was 3 weeks in between the first test, 2 weeks, then 1 week. I'm just making it up again. But just to, conceptualize what's happening. What I kind of described there was an ascending triangle. We have three higher lows and we have a level of resistance. We work through that supply. It's free to run.
That's very, very good. Another question I had for you was regarding types of instruments to use. It seems to me like stocks would be the best, instrument, something that's pure. If you go to an overall market or an ETF, you've got a combination of things and it could work on average, but is it better? Is it a better tool for instruments that are single, like a single stock or a single instrument versus like a market? I know it works, but
yeah, I use it for both. Again, I'm referencing here the NASDAQ 100,
right? But but my question was, is it more pure and a better tool practically, because there seems to be a little bit more noise in an overall market and less group. There's group psychology, but the group psychology is not as intense as it is in an individual instrument, or is that false?
I'm not sure I can give 100% objective answer here because my preference, I'm a stock trader first and foremost. I do trade the ETFs in particular. Last year when we're in a bear market, it helps mitigate the single stock risk. And I would trade those a lot more aggressively. But I prefer individual stocks. To me, they do trade cleaner, is kind of what you're talking about here than the indices. You don't have as many factors that can go against it, Fed statements. Stocks are going to trade, the good ones are going to trade on their own merits. They're going to buck the trend of the overall market. However, if the market is in a decline and I have a stock I like on the long side, I'm going to use that information to say, maybe be less aggressive in terms of my share size and how much risk I put out there. My tolerance, I'm still not ready to commit, fully to stocks in this market environment that we're in here at late February, because we just still have too many cross currents. The market is maybe in a stage one accumulation. And I say maybe, I don't know. We could just, fall apart from here. We only know it was stage one when it breaks to stage two and it holds on. Otherwise, it breaks out and then it fails. What was a failed stage one, stage two breakout? That's why it's, the cornerstone to the success is always risk management. We can
Mhm.
have our assumptions, but if we stay with those assumptions and think we know what the market's going to do, this is how I've had all my biggest losers in my career, is holding on to the market, to the stock and saying, well, the market's wrong on this one. I know, I've got it. I even read the 10Q, whatever.
Yeah, that's going to help.
I've never done that actually.
Oh, that's funny. Yeah, that's a little clue. Sometimes reading the 10K will not help you.
No. If
If
you're reading a 10Q, I think you're looking for something to justify your big losses.
oh gosh. Well, I have so many different things going through my head right now about VWAPs. I was thinking about the systematic traders that I know, and like, what would they do with this concept? You could, if you were, let's just pretend you were not a discretionary trader right now.
Mhm.
What would be an approach that you would take as a quant trader to create the criteria to anchor to a date? In other words, would it be the above average volume over the last 3 days? Would it be a peak that has a strength of 3%, or something like that? There's so many conceivable things you could do with this. It's like, it's crazy.
Oh, it absolutely is. I mean, even just to go backwards for a second. I mean, if you think about, I'm talking about a trend trading tool, but you also have to remember that there's value players, and a value player looks at it and goes, hey, it's below the year-to-date VWAP. I'm doing great. I'm buying it at a discount. This is what I want. Whereas the growth manager says, oh, shoot, it's below that. I mean, is this thing failing? What's going on? Do we have to dump our position? So, and there's longs and there's shorts and there's, scalpers and there's longer term holders. I brought up the example of Oxy today. Warren Buffett's holding that, and it's finding buyers at the December of 2021 low, the anchored VWAP from there. I think it's probably going to shake out, and if they're really supporting it, then it's going to go back up through there. I'm not answering your question though. So my point would be, Lewis, I would look at key events, earnings reports, and I would say, okay, typically after an earnings report, it might run 2 to 3 days, but then it's going to pull back, and a lot of times it'll pull back under the VWAP, and you'll have about a week and a half of just kind of a battle back and forth. And then as it gets above the volume weighted average price on day 8 or something, that's where, to me, okay, we've had the shakeout. We got out the nervous Nellies and the short sellers got loaded, but the buyers are back in control. Now here's where I want to really load into this thing. I would do something like that. I would measure from a Federal Reserve announcement always. I always want to look at, so depending on the time frame, I would look at the highs and lows. So let's say I was scalping the E-mini futures. I would say, I want to know the high, the most recent high, but we've pulled back at least 1/4 percentage point. And if I was to take that into a daily time frame, I might want to say, I want to know a stock that made a high within the last 20 days, and we've pulled back at least 4% from there, but it's holding above the volume weighted average price anchored to the low of the last 30 days. So it's now pinching between those, and I would want to identify those. So those are, you could go crazy with this thing.
There's some things you can do.
Yeah.
And I promise you it's going to get done. So
absolutely. And
the squeeze, you says the squeeze. I hadn't thought of it as squeeze, but the squeeze is like the thing. I love it. The squeeze. You've got a basing pattern. You've got the high. You got, if we're talking about the same thing, you've got it off of a high coming down, and you've got it off the low, and it kind of converges, and you can get some ideas about where things are. That has been something I've been doing for a while. In fact, I mentioned that.
Pinch.
What's that?
I call it in the book. There's a chapter about it in the book. The anchored volume weighted average price pinch. So the energy compresses and they pinch together, and the momentum, it gets compressed. And when it comes out of there, it comes shooting out a lot of times.
Yeah. I mentioned that scenario in, it was a longer term scenario on that stock charts when I mentioned that a lot because I want people to see the VWAP. And I had mentioned that because I guess Stock Charts put it on their
They
platform
did
now.
about 2 years ago. Yeah.
You said that there's a bunch of software programs, or there's a handful of software programs that now allow
They're
for
all
this.
rolling over one after another. They're all adding it. I think it was eSignal maybe just added it like in the last 2 weeks. You've got TC2000. You've got Trend Spider. Trading View is a popular one. You can do a lot with their free version as well over at Trading View. You've got
Should get Marcus
Optima.
Smith to do it.
Market Smith, I've been talking to them. They're still digesting being absorbed by Dow Jones and Company, but they're going to revamp their charts.
Yeah. Well, they have a good product
Absolutely. I
on
love
the
it.
fundamental side. All of
Yeah.
those that you mentioned have good products.
Going back just for a minute though, Lewis, what that pinch represents is kind of what we were talking about. So if we have that low from 30 days ago and the stock had a significant rally and it made that peak 8 days ago, well, we don't know it was a peak 8 days, on that day it made it. But after a day and a half, as it begins to pull back, we say that looks like a significant high. I'm going to put an anchored VWAP on that and see how it starts to flow. And then what I'd really like to see happen is maybe a nice shakeout down to that anchored VWAP from 30 days ago, touch that, bounce back up, and see again that compression in between the two VWAPs. And because we've got the longer term trend is still clearly higher. So the trend once established is more likely to continue higher than it is to fail. So we look at that pullback and we say, from that highest point, I know there's short sellers in there and they're feeling pretty cocky. And there's longs who are buying the dip and they're starting to feel doubt. What would make them feel better about that is if it gets back above the average price from that peak. What would make the shorts feel like, oh boy, maybe I messed up here, is if it got back above the VWAP from that peak 8 days ago. Now, both of those are heading higher and the buyers are in control from the low and the high at that point. That's the lowest risk place to enter. Unless it rallied, 3 points to get there in a day. Then you've got to expect maybe go down to your 1 day chart and look for it to pull back below the VWAP, hit the 2 day VWAP. And, you can go on. And I wrote about that. There's a chapter about multiple time day VWAPs for shorter term traders as well.
There's a lot of nuances that can be used with this tool. It's a very versatile tool. It could be used in a lot of different ways. And I think one of the things that I enjoy about it is it's really good for people who are more discretionary in some ways. And that leads me to a question about strategy. So in your trading. So when you're trading, you're taking smaller time frame positions, but since you have less risk, you could take somewhat of bigger positions if you're in the mood for that. And your reward risk ratio can be higher than 2 to 1. It could be 5 to 1, 10 to 1. It could be much bigger. But you can, if you have one trade that goes against you, especially in stocks, you can wipe out a lot of trades very quickly in swing trading type strategies. What is your kind of the best way that you find to mitigate that problem in individual stocks where you can have unexpected events that happen in the middle of the day, even though you've done all your homework?
The absolute best thing that I've incorporated over the last several years, the last 10 years really, is, as you mentioned, I can get a bigger position. And I like to, when I part of what I'm really good at is the entry. Because I'm buying actually at the point where the buyers take control. And it just happens to be where the momentum often is defended and continues. So I like to get in heavy, as you mentioned, to take an uncomfortably large position. But I quickly, when the stock starts moving in my favor, I'll sell some at daily R2, which a lot of people may not know what that is, but that's fine. But it's just a mathematical formula. And I think, 86% of a daily range is contained within S2 on the downside and R2 on the upside, some statistic like that. So, and institutions use those as well. So I almost always sell a third of my position. I might, let's say I buy a stock at 22.50 and R2 is 23.05. I'll sell a third there. Even though I look at the chart and say, this thing could go to 30, I will always sell there. And what I've done is, taken, let's say I bought it at 22.50. Let's say I sell some at 23.10. That's 60 cents. So what I've done is taking 60 cents off. I've lowered my cost basis on the 2/3 position, basically. So I'm reducing that risk. And ideally, if it's run that far, I might be able to raise my stop up on the balance a little bit to a point where if I get stopped out of there, considering the 60 cents I took on the first third, I might even come out of break even. As the stock either reverses and I get stopped out and take a small loss, or if from the very beginning, if I take that large size and it's just kind of sits there for an hour, 2 hours, I'll think it's supposed to go, but it's not. So I might sell half of it and then watch it really carefully, and not really honor my stop, but get out ahead of the stop because the momentum I was expecting, there's the time consideration as well as the price consideration. And if it's not moving when it's supposed to, it might not move at all, or it might be a trap. So I don't want to get stuck there. For the balance, for the 2/3, assuming that I have that first third off, what I do is I look at the definition of trend, usually on a 15-minute time frame. So if it runs from 22.50 to 26.40 and it pulls back to 25.80, then it runs up to 27.05, I'll put my stop under that low at 26.40. So I'll put it 26.38. And as it pulls back and makes another higher low, I'll raise my stop under that. And then if it breaks out at 28, I'll sell another third, and I'll keep that final third, and I'll keep that third in play as long as the definition of trend is valid. I'm not looking at price targets so much and saying, well, I need it to get to 31, and then I'll sell it. But as long as it's making higher highs and higher lows for the time frame I'm engaged, I'm a trend trader. So why would I hold it if it makes a lower low? That's just dumb. It's the definition of trend isn't there anymore. So that's how I ideally like to, manage a position for a swing trade.
Okay. Yeah. And that concept can be used for longer term timeframes too. So
absolutely,
maybe you take a little bit more off at 1x your risk. You're using S1 and S2, which is a different thing. It's based off open, high, low, close data.
Right.
I hadn't heard that in a while. I remember trading a bunch of futures or testing a bunch of futures programs off of those, that information. There was a system called R-Breaker that used, I don't know if you remember R-Breaker.
Yeah, they call them the floor trader pivots. It's an old formula that floor traders used to use. And, and like a lot of technical analysis, Louis, the value is that enough people believe that they are a thing, so they will program their computers to say, hey, it hit daily R2 today here. Let's sell part of our position because 86% of the time the stock is contained. I think it's actually 76. There's actual a lot of study has been done around these. 76% of the time, that's the range for the day. So I look at it and say, well, the odds favor that this is close to the high for the day. Or if I really like the stock and it's moving strong, then I switch to, okay, it's a daily R2. That's a level of interest. I don't have to sell here, but I'll look at a 2-minute chart. And as long as it's making higher lows on successive 2-minute bars, I will hold it until it breaks the 2-minute low. So, that might be a little complex to describe here without seeing the chart. Let's say the range for a 2-minute bar was 26.10 to 26.20. And then the next, so as the next 2-minute period opens, my stop will go at 26.08. The next period, 26.18 is the low and 26.32 is the high. It opens a new range. So I'll set my stop 2 pennies below that 26.18, putting my stop at 26.16. So if you've got this stock that's just shooting up on momentum, you're not interested in looking at the news to figure out why, it doesn't matter, but just trying to maximize that initial little rally that most likely will fail. That's an alternative exit.
So it actually reminds me of the picture behind you.
Right.
That picture behind you is, some people will think about the Fibonacci ratio with that picture.
Yeah, absolutely.
And so markets are fractal, which means that what you're talking about in your time frame, not everybody's going to want to sit in front of a computer, all day doing that, right? But the concepts that you're talking about can be applied for traders with a longer term time frame because markets are fractal. And I just wanted to bring that up because I know some of the people that may be watching this are like hell, I'm going to be sitting in front of a 2-minute chart, right? but it's important. The concept of what you're saying is very important for a trader. It's like, and basically you're almost doing two styles, because when you're taking some of that off, you're basically acting like a mean reversion trader, because you're taking some of that off like a mean reversion trader would.
Yeah.
And then you're acting like so you're basically doing multiple style of trading in a single trade. And then you're also giving yourself multiple time frames. So, which, probably the best traders I know do that. Almost all of them do that. They trade around a position.
When you say two different styles, in a way it is, but and here's the key is that it's my style, and everyone will look at seriously. And I'm not saying that no one else does it this way. I'm just saying that everyone has to say, what is my time frame? What is my style? I went, I did about a page of the fractal nature, and then I must have mentioned in the book, reminder, this same concept applies to every single time frame. It is no different because of that fractal nature. I must have reminded the readers of that 20 times in there, because I would go on a chart with a shorter term time frame and I think, okay, well, some people are going to lose interest here. I have to remind them, just because we're using this time frame doesn't mean it's not relevant on a larger term time frame. And I put a lot of longer term charts in there as well.
Yeah, that's great. Well, that's great. I appreciate your time. You spent a good amount of time with us, and I appreciate all of the wisdom that you've bringing to the table here. And thank you for bringing the VWAP up to the forefront, which people have not been able, kind of was sleepy for a lot of traders. And now it seems to be gaining more momentum to others.
Yeah, big time.
Yeah, you should hold up your book. I was
looking for a copy.
Come on.
The only one I have here is, so I have a bunch of them in my office, and I don't want to get confused. So I wrote desk copy, so I don't get confused. And anyway, so that's it.
Yeah, so you can get it on Amazon. And are you offering any other place other than Amazon, or is that where you like to send people?
It's on Google Play Books if you want an ebook. It's also on Barnes and Noble as an ebook.
Okay. So one last thing before we head out. Is there any project that you're working on right now that you're excited about that you want to share with anybody?
Not that I want to share, but I've got a really good project I'm working on. Yeah.
Okay.
It's great having this one out of the way, and I thought I was going to relax for a while and just kind of ride that wave a little bit. But I've got some good stuff in the works, Lewis.
Yeah, definitely. I highly recommend picking up the book. Check out Brian's stuff at alphatrends.net. Brian, thank you so much. Good stuff.
Thank you, Lewis. Pleasure.
Talk to you soon.
Okay, you got it.
The information in this podcast is informational and general in nature and does not take into consideration the listener's personal circumstances. Therefore, it is not intended to be a substitute for specific, individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision. WealthNet Investments is a registered investment advisor. Advisory services are only offered to clients or prospective clients where WealthNet Investments and its representatives are properly licensed or exempt from licensure.